Well, all I do know is people are record negative sentiment. They're more negative than I've ever seen. The moment the real rates go negative again, that's destroying your future wealth. Gold does pretty interest rates. Right now, the interest rate market has no buyers. There's no buyers of bonds. I've never seen this one. It's probably not the vehicle if you want to create wealth. It's a vehicle to protect wealth. Is going to create the answer, and the answer to everything is always more cash. This drawdown, they blew up the pension system, and the Bank of England had to come and stop. The bond market to me is broken. It is now a function of illiquidity because the fact that pension portfolio has been obliterated. So if you think what just happened in the UK, there was some leverage. Here's why. The dollar is in this doom loop where it's a game of musical chairs. The musical chairs here are the US is 25% of world GDP. 87% of world trade is in US dollars. Most international borrowings are in dollars. The euro-dollar market is the epicenter of that. The issue is when the Federal Reserve start taking money out of or liquidity out of the system, it knocks through to this murky world of euro dollars and foreign dollar borrowings. And those weaker borrowers start scrambling for the dollars. And it's a game of musical chairs where somebody gets rug pulled and somebody falls to the floor because there's not enough chairs to go around, not enough dollars. That was Sri Lanka. That started this off, and I tipped you guys all off about it back in March, I think it was. Then after that, we've seen numerous countries go into default or renegotiate with the IMF and the World Bank and others. That's the shortage of dollars. The shortage of dollars is what puts the European banking system under pressure. The shortage of dollars kind of knocks through for the global market. Now, there's another issue going on right now is the US, its trade deficit. If you think of a trade deficit, it's the US buying goods abroad. That's spending dollars elsewhere, so the rest of the world gets those dollars and they get to recycle them into treasury bonds or do other stuff with them, have borrowings against them. When the US runs a smaller deficit, there's less dollars in the global system. So that makes another problem. So you've got liquidity being sucked out, and you've got the trade deficit, meaning less dollars are going in the system. Yet in a slowing economy, everyone needs to pay the interest on their debts, so demand rises. That's the mess we're in. Foreign central banks end up having to sell their treasuries to either support their own currency or because they kind of need other things to be able to do with the dollars that they hold. That becomes an issue, or they want to receive the dollars to pay off the interest on their debts. That becomes an issue because it's driving higher interest rates. Right now, the interest rate market has no buyers. There's no buyers of bonds. I've never seen this before. You see, the issue is traditionally the buyers for foreign central banks, they're out of the market. The Federal Reserve with quantitative easing, they're out of the market. The banks, the biggest buyer of all. Regulatory purposes meant that they can't do it. So cash is piling up in the reserve repo market. So there's trillions sitting in there with nowhere to go, not being put into the system. And the pension system. And the pension system has just taken the biggest loss ever in the 60-40 portfolio. That's the portfolio of equities and bonds, 60% equities, 40% bonds. That was the safest investment style of all, and the entire pensions industry worldwide uses it as its benchmark. We've just had the largest drawdown in the history of that strategy. This is unprecedented. I know everybody looks at the equity market and says, well, the equity market's only down 30% if it's the NASDAQ or 20% if it's the S&P. They're missing the fact that pension portfolio has been obliterated. So if you think what just happened in the UK, there was some leverage to cover their liabilities. And with this drawdown, they blew up the pension system, and the Bank of England had to come and step in. So that's the dollar problem. The dollar problem is great for the US right now because it means that anything you buy from abroad, particularly the US buys an enormous amounts of finished goods from China, Germany or Europe, Japan, South Korea, Taiwan. Those are the big industrial nations that export goods. All of their currencies are down between 15 and 30% against the US dollar. So the US dollar imports deflation, not inflation from those countries. Those countries are importing inflation. So Japan quashed their bond yields by yield curve control. And that has the knock-on effect of them printing more currency, which devalues the yen. So we go back to the previous conversation is, guess what? The yen in gold terms, or gold in yen, looks great because somebody was devaluing their currency, and gold helps you nicely sidestep it. What role does gold play in the investment landscape? You see, there was a narrative from the 1970s that has been held on to, particularly by boomer types, which is that you see one day this financial profligacy will create a bull market in gold again. When you look at gold mining stocks since the 80s, they've actually not gone anywhere. When you look at gold, it has risen, but it's not risen with inflation. In fact, in real terms, gold's gone nowhere. In fact, it's probably down. The reality is gold does a certain thing and it does it really well. Gold works really well when you debase a currency. Remember in the old days, they used to debase gold by clipping the corners off the edge of coins. They don't do that now. What they do is devalue your fiat currency. When you look at a chart, and I've got a global macro investor chart of gold over the last 20 years versus a basket of 27 of the largest currencies in the world, excluding the dollar, gold just kind of ratchets higher, and it ratchets higher every time there's a devaluation of other currencies. It also works okay against the central bank balance sheet. It's not racy, but it kind of does its job. So gold right now, when you've got positive real rates, and they're going up a lot because the bond market's decoupled from everything else, what you've got is a bad environment for gold. The moment the real rates go negative again, that's destroying your future wealth. Gold does pretty well. Now, I don't think gold is the best investment to capture this tail risk. I actually think crypto is much better at doing it. I actually think technology stocks are probably better at doing it. But gold is less volatile, so risk adjusted, it's just fine. It's right now, it's just not a good bet. And even though not that many people own it these days, it's not a retail investment vehicle. Sure, in India it is, but even in India, we're seeing the rise of crypto. Actually, the point about India is actually quite interesting, is if you look at gold in terms of rupees, if you look at rupee itself, it's devalued over time. So dollar rupee has been doing that. Then after you adjust it for gold, i.e. Indians buying gold, they've actually outperformed the rupee perfectly. They've maintained their purchasing power over an extended period of time. So it works very well for stuff like that. Works very well for emerging markets and really good for debasement. It's probably not the vehicle if you want to create wealth. It's a vehicle to trade. The pain trade, I think, is to sucker everybody in thinking there's a great glory collapse to come. The I told you so moment in earnings are going to get revised lower. Well, all I do know is people are record negative sentiment. They're more negative than I've ever seen, ever in any history. I wrote a big article in Global Macro Investor, my institutional research service about this. They're super negatives. People are super hedged. Put volumes have been incredibly high. So I think the path of pain is to go lower, suck more people into short, and then rip higher. And it would rip higher because bond yields start to fall as they start finally recoupling for the business cycle. Bond yields have massively decoupled from the ISM survey. That's a relationship that's gone back 50, 60 years, including the last inflation episode. It's decoupled from inflation break-evens. It's decoupled from economic growth by any measure. The bond market to me is broken. It is now a function of illiquidity because nobody's involved in the market and there's only sellers. And I think it's going to cause some tremendous problems. And that eventually is going to create the answer. And the answer to everything is always more cowbell. The UK showed it, more cowbell, print more money, get us out of this problem. When people say they'll keep hiking until it breaks, well, when it breaks, more cowbell. You know, it's all, the whole system is now set up for one cry, which is more cowbell, turn the taps back on. It's a sad state of affairs, but that's how it is. But you can trade that to your advantage. Trading it to your advantage is understanding when that shift comes and what it does for risk assets.